Monday the 6th of November. It's getting the briefing underway, and a couple of things to discuss. First of all, looking at an overview of the charts this morning. Oil is a bit of a focal point because of some news developing, in particular in Saudi Arabia, which I'm sure you might have read some of the headlines already, but we'll talk about that. We'll also have a look at some of the other things like the oil rig count, which came out on Friday, which was fairly significant as well in regards to got the lowest US operational rig count now number since around May of earlier this year. We'll then also look at some of the economic data forthcoming for the week, and then a review of some other things to also be aware of from the weekend's press. So that's what we're going to cover today. First of all, as I say, looking at the charts from a kind of top view perspective, oil is probably the one standout. In the FX markets, things are relatively quiet. The dollar index is basically flat, and that's kind of really played out in the major pairs. Not a great deal going on at the moment. Euro dollar sub pivot, as to is cable, at least for the time being, sitting at around that level. The pivot level in the cable pair does match up with around the 131 handle. We'll have a look at the Bank of England shortly, but one thing is, if you were looking at these charts, then non-farm payrolls really didn't have much of a lasting impact, if anything at all. We kind of really knew that. If you remember, the headline reading came in lower than expected, 261,000 against the expected 310. More in line if factoring in the upward revision, though, to the previous of 51,000, so the prior month's reading. I think the 2-month net revision was plus 90. The labour market still remaining fairly solid. The October unemployment rate down to 4.1%. That's the lowest now since December of 2000. The wage data was disappointing. So if anything, though, does this really change what the Fed are going to do in December? Well, market pricing would reflect that no, people aren't panicking about that. And then probably more so is going to be reevaluating the data as and when Powell will take over when Janet Yellen's term finishes at the beginning of February of next year. So no real lasting impact from non-farms, as it has been the case of late, and particularly really last Friday's report, given it was a rebound from the weather depressed September report when we had that negative 33,000. Remember, that doesn't exist anymore. That's now a positive 51,000 number when we look back on the statistics. So looking at oil, let's talk about that as the main story of the morning. And looking at the charts firstly, you can see we've already surmounted a $56 handle. This little spike in prices that we had about an hour ago really was Europe coming into market and reacting to some of the news at the weekend. We broke the initial overnight futures high, which was printed Sunday evening at pretty much the $56 handle, acted as a bit of a barrier psychologically, and then we broke through there to run up just above R1 before then settling and finding a bit of a floor back to that handle. Looking at this on a longer dated time frame, this is a weekly continuation. You can see that where oil is trading at the moment, obviously we found some resistance last week at the late 2016, early 2017 high, which was essentially the $55 handle, but now we've breached that firmly. A pretty quick run up to this $56 price point, and so this is the highest level that crude has traded now since 2015. Looking above here, not a great deal in the way until you start getting up to the $60 handle, which I guess, given some of the news which we're going to discuss in a minute, cannot be discounted in combination with the fact you've got the OPEC meeting, which of course is looming. That's going to be at the end of the month, only about 19 days away until they hold that official meeting in Vienna, where a lot of people are looking for an extension of the existing OPEC non-OPEC production cut deal. So a lot of people remaining pretty bullish this morning for crude, and this does of course come in the context of the likes of Saudi and Russia continuing to back an extension to the existing cuts. So let's talk about the headline. The main piece of news from the weekend was this, and as the FT are writing, oil price firms as Saudi Arabia target the elite. So at the weekend, basically arrests of at least 11 Saudi Arabian princes and dozens of senior officials and prominent businessmen by the country's new anti-corruption commission. This has been put in place by King Salman, ordered the establishment of this new commission, and of course he's named his son Mohammed bin Salman as the crown prince to be the person to drive this new initiative. This does mean though that there's been a lot of people drawing comparisons to a bit of Game of Thrones going on, because it does involve people very close knit in the family, in the royal family structure, a lot of the old guard being completely removed in order to facilitate a bit of a clearer run, if reading between the lines, for the crown prince, where the king is expected to potentially step aside either later this year or next year. So it's kind of safeguarding passage, I guess, for the shake-up that happened when this new 32-year-old came into place only in the last maybe year and a half, and so that when the king does step aside, he's got a clear run of control. Now, a few other things to be aware of. One of the most kind of, in a Western sense, names that will probably be talked about a lot when you watch US networks later on this afternoon is the billionaire tycoon Prince Alawid bin Talal, which is one of the world's richest men. He's in the top 50, but he's a major investor in the likes of Citigroup, Twitter, in the European side, Accor. They are seen down about 1.5–2% this morning. He's also an investor in them as well. So quite a prominent figure, but this does definitely fit with what some are calling the shock and awe tactics of the new Saudi regime, which is as part of their Vision 2030, this kind of move away from such heavy reliance on crude oil as a source of revenue, and looking to diversify that income. Now, there's been a lot of talk, of course, about where Saudi Aramco's IPO is going to take place, whether in New York or London. So no doubt you can expect probably Donald Trump to be talking about the issue. You've also had that $500 billion super city being talked about in Saudi Arabia. Just this ongoing reform agenda. I don't think it's entirely surprising of what's happened, because I just think that this then continues that narrative for what is preparation for when the Crown Prince Mohammed bin Salman becomes the king in the coming period, whether that's sooner or later. So reaction in the market has been relatively contained. The local market has seen a little bit of volatility when it reopened at the weekend, but oil prices, if anything, if you think about the commentary in which we've had from Saudi Arabia, particularly the Crown Prince last week, he has been very vocal that the government, so this isn't the oil minister speaking, this is the Crown Prince and the government saying that they 100% back a continuation of an extension of the existing OPEC deal. This is one of the predominant reasons of why we were rallying last week. But now that we technically got above those key levels at around the $55 price point, so through year-to-date highs and the highest in 2 years, and certainly this does start to open up some upside from that perspective. Just to give you an idea as well, the king also relieved Prince Miteb bin Abdullah from his post as head of the powerful National Guard. That chap seen as one of the last senior royals, and also who has control of the National Guard, is said to be an extremely pivotal player within the structure and how the country is kind of governed. And so what's happened then is that now the young Crown Prince has taken control of every level of power, from defence to oil policies, because he has also, of course, was the person in charge of putting El Fali in place of Al Naimi about 18 months ago. So this reform agenda continues in Saudi Arabia. I definitely think that tensions in the Middle East do need to be watched. You've also had the Lebanese Prime Minister resign quite coincidentally at the weekend, who also has very strong ties to the Saudi royal structure as well. So I definitely think that this region needs to be watched, and any destabilization between the likes of Saudi and Iran, for example, could act as further support for the likes of crude oil going forward. So that's the kind of the Saudi situation, but it's not just that news that's ongoing. This is a graphic here of OPEC-led output cuts, which have helped push this price of oil to 2-year highs. What we're looking at here is the white line, which is the price of oil, whereas what you can see from this morning, we are up at this $56 level. And then you've got the OPEC output figures. So if you remember back in January, this is when the OPEC cut came into fruition. Compliance levels have obviously fluctuated. But then this is one of the other things that we've been looking at, is the weekly change in the number of rigs drilling for oil and gas in the United States. Now this is the cumulative number, so this is oil and gas. If you take that figure, it was down 11 on Friday according to Baker Hughes. The US operational rigs were down 8, which takes them to the lowest now since May. So we were looking at rig counts. If we go back to really the beginning of this year, we were adding, in terms of rig drilling in the North American market, we were adding about 20 at the peak. Now we're down to minus 11. And as you can see, as we've gone through the last kind of quarter, I guess, this has started to slow down quite considerably. So this fear of a runaway shale industry that was going to be forever pumping more and more oil is probably starting as a view to dissipate. If that is the case, if US rigs are declining and US output has hit a peak, and so therefore we can say that it's not going to rise too much further, coupled then in with an extension of an OPEC cut deal, so this extension for throughout 2018 is what some of the sources last week were suggesting, potential then confrontations or destabilization in the Gulf, then certainly you can see why a lot of people will be feeling quite bullish oil. And this also fits into the context of the likes of what Citigroup have been saying for a number of months about the potential that actually the demand starts to catch up. We've got global economic growth ongoing across the world, and then if supply starts to diminish quicker than people anticipate, because countries like Libya and Nigeria, who've been cranking up oil as they were exempt from the OPEC deal, start to reach maximum capacity, well actually your supply has kind of hit its limit now, but demand is continuing to creep up. So hence the reason as well to be quite bullish oil, and certainly I don't think you can discount $60 in the coming months, that's for sure, if not weeks, if the news kind of fits in step with that view. Okay, a few other things to have a look at. Let's have a look at the pound on a slightly longer dated time frame, and obviously we need to take it in the context of this really big decline that we had last week. That of course was the dovish hike. So for the first time in over a decade, Bank of England hiking rates, but sounding incredibly dovish about the prospects for the future, largely clouded by the uncertainty that their projections will carry, given the fact that they don't have much clarity on the Brexit situation and how that will play out, whether a transitional deal secured or worst case a hard Brexit scenario. But we have found a bit of a floor, so for the time being the downside level of significance as we go through the week, if it were to retest, which would be important, would be the 130.53 handle on the intraday. That's matching up quite closely with the S1 level. I guess if we start looking a little bit longer time frame to where we are at the moment, if my chart just updates in 1 second. So that 130.59 is a pretty important level. You can see there where it's managed to support the price post this dovish Bank of England communication we had last week. That was also the low back in October. It was a resistance point back in the summer of this year and also back in May as well. So any push below this point, definitely that 130 psychological level would likely be targeted. but that is pretty much just psychological. There's not a lot of technical relevance to that level, and it certainly could open up some of the downside. And going into the Christmas period, obviously things like monitoring ongoing performance of consumers' confidence, and also retail sale metrics over the Christmas period, which are incredibly important for our service-driven industry, will be particularly relevant. This was one chart though that I wanted to show you. Let me see if I can make it a bit bigger. This is market pricing in short-term interest rate futures, essentially. So looking at the second hike from the Bank of England is currently priced at the end of next year. If you remember what the Bank of England were telling us in their quarterly inflation report, it was essentially saying that we're going to have a rate hike, or 2 rate hikes, by 2020. So the reason again for this really dovish reaction to the Bank of England is that this isn't a traditional initiation of a sequence or a cycle of incremental rate hikes that we're used to seeing, a la like the Fed. This is very different. This is a very gradual and to a limited extent, was the exact words that they used within the minutes. And so the next Bank of England interest rate hike of 25 basis points is not actually priced in until August 2018 or later, i.e. going into 2019. So you're not going to get another interest rate hike for at least another 12 months. However, one of the things that I was thinking, and I was reading some research over the weekend, is that I definitely think that a transitional deal is imperative and not optional as far as the UK is concerned, to safeguard its economic and social future going forward for the people of Britain. And so I do think that a transitional deal is inevitable. Whether or not it will happen before the end of the year is uncertain. I would say there's going to be a big push politically, domestically at least on our side, to try and secure that. But whether or not we will make the sufficient compromise to pay a bigger fee than 20 billion is the question point in regards to that divorce bill. But one thing that I was thinking at the weekend was, looking at this market pricing, I do think though that this is probably about as dovish pricing as you're likely to see. It might have a little bit of a push to become even more dovish if they don't secure that transitional deal by year end. But once that is secured, and I think it will be in the next 6 months or so, then actually I think you might start to see then the pound appreciate in regards to clarity then secured for the near-term horizon, if you like, for the next 2 to 3 years to then negotiate trade talks. That should then instill some confidence back into the market. If sterling starts to appreciate, that might mitigate then rising inflation, helping the Bank of England. And so then I think you might start to see this shift. So really, market pricing, I think, for the Bank of England, when are they going to hike, is a completely finger in the air scenario at this point. And it's not until we get more confirmation on how this Brexit negotiation is going to play out before we can really start to rely on Bank of England's forecasting for the future of inflation, growth in this country, and so on and so forth. Okay, a few other things from this morning. You've had German manufacturing orders unexpectedly rise in September. So this came out early this morning. German factory orders rise for a second straight month, albeit hasn't been any real reaction in the market to this. I think German economic data, generally speaking, has been fairly assured and robust. And then let's just have a look at the well, let's skip this for a moment, we'll come back to that. Let's look at this report. This came out at the weekend. If you recognise this chap, this is one of the senior people on the FOMC. This of course is New York Fed President William Dudley. Now we already know from last week, confirmation then that Jerome Powell is to take over from Janet Yellen come early 2018. And every year we see a subtle rotation of the presidents of the other regional banks who then roll on to the FOMC. We've discussed this before. From a hawkish, dovish perspective, the FOMC board is going to take a slight tilt back to becoming more hawkish. Now, Dudley, quite interestingly, is not actually due, I think, his term to expire until 2019, but he's come out at the weekend, or sources have suggested, that he's preparing to retire earlier than planned. And actually, he's going to announce it potentially, I think when I was reading this article later this week. He could announce his retirement as soon as this week and step down as early as spring 2018. Once a replacement is named. His term wasn't due to finish until January 2019. Now, Dudley generally has been a backer as a vice chair of what Yellen's communication has been. So if you think about it, you're getting a removal of Janet Yellen, you're getting a removal of Dudley, and then you've got a lot of spots that need to be filled now. And so it's going to be very interesting to see how, if economic data continues to improve as to the underlying conditions in the US, then how aggressive will Jerome Powell as the new Fed chair become? Because we are now underway in quantitative tightening of the balance sheet and a sequence of interest rate hikes going forward. One of the interesting things I was reading at the weekend about Jerome Powell and how is he going to govern the Fed, one interesting point is that maybe Trump's thinking was to back Powell rather than Taylor, because if Powell continues the similar approach to that of Janet Yellen, well, it's Janet Yellen that's created all-time highs in the US stock market, which definitely plays into the theme and a narrative which Trump has been trying to push, and that his leadership is creating these types of record high valuations because of the confidence in him and his administration. Of course, we know that's slightly not the case, but certainly does fit his political agenda. And so one of the interesting things will be, as the economy continues to improve in the US, as inflationary conditions start to pick up, let's say, as the Fed intend, and the labour market continues to tighten, what happens then to Jerome Powell? Can he afford to raise interest rates more hawkishly, more aggressively, at the sake of then maybe equities coming under pressure? If equities start to correct, this is definitely something that Donald Trump would not want to see. So yeah, it's going to be very interesting in terms of the composition of the Fed going forward into next year. Okay, quickly a look at the calendar for today. Typically the Monday after non-farms is pretty quiet as a schedule perspective. You do actually have Fed's Dudley speaking later on this evening at 5 PM, so maybe something to keep an eye out on. In terms of this week, a couple things here to have a look at. Trump's Asia visit. So on Sunday, US President Donald Trump embarked on his 12-day trip to Asia. So I guess key things that you're looking out for are he was with Japanese PM Abe at the weekend. There was a little bit of movement in the Japanese yen overnight, as Trump was a little bit critical of the trade partnership that they have with Japan. You also had some dovish comments coming out of the head of the Bank of Japan as well, but that yen move has since been retraced. But then obviously the hot topic is North Korea. Trump will visit China, where he'll meet with Xi Jinping. And so a lot to look out for on that front, and particularly given the very hostile environment politically that's ongoing in the East China Sea. Other things, just quickly to draw your attention to, earnings season begins to wind down, but what's interesting about this kind of final week or so of earnings in the US for the S&P 500 is that we go from technology, obviously it was Apple, Amazon, Facebook all last week. Now we get the department stores, which actually can be, although the companies like Macy's, Nordstrom, Kohl's are relatively small in a market cap sense, what is important is the direct read across then into sentiment for the US consumer and their appetite to spend. So when these come out, definitely worth keeping an eye on, with particular attention to the guidance for the holiday quarter. Because if you remember, in the UK last week we had Next, who were incredibly cautious about the prospects of their performance over Christmas, which is a real crucial period for the retail sector. And so these could be certainly market moving from a sentiment perspective ahead of the cash open if you're looking at the futures market. So something to be aware of. Looking at the week as a whole then, moving beyond today, you get the RBA interest rate decision overnight. Going into Tuesday, we'll be reacting to that. You also get industrial production, construction PMI for Germany on Tuesday. And then your oil inventory numbers as per usual. Quite a few ECB speakers to be aware of as well. Wednesday, pretty quiet. The only real thing of major significance from a scheduling point of view is the weekly oil inventories. Thursday, Chinese inflation data. Your weekly jobless claims out of the US. Then on Friday, UK trade balance, manufacturing, industrial production, University of Michigan, and then we'll be looking at that Baker Hughes oil rig count again. So pretty quiet, but this is always the case post that first week when we have the PMIs and non-farm payrolls and so on. But definitely things to look out for are really the situation in the Middle East. What's the lasting impact from what's developed, because it is still a fluid situation in Saudi Arabia. So monitoring of oil prices in that regard. Any further commentary as well in reference to what they might do, i.e. the Russians and other OPEC nations going into the OPEC meeting at the end of the month. Then I'd be monitoring out for any comments in regards to relationships between Donald Trump and Far East Asian partners, i.e. China and the North Korean situation. Ongoing, I guess, lower tiered to that would be anything furthermore on the Brexit situation. But I think at this point in time, unfortunately for Theresa May, she is dealing with a whole host of harassment claims and so on within her own political party. So domestic issues are probably going to be more something for her to focus on this week rather than Brexit, so to speak. Okay guys, going to leave it at that. So have a good week. I'm in the chat room throughout the day, so if there's anything you need, just let me know. Alright, have a good day and a good week. Thank you.